Today, millions of customers treat Amazon as the default infrastructure for global consumption. It is a smorgasbord of selection, delivering everything from inflatable cat toys to 1,000-pound electronic gun safes in a matter of days. The common narrative suggests this was a lucky accident of the dot-com boom, a plucky startup that happened to be in the right place at the right time. But in 1994, Jeff Bezos was a vice president at D.E. Shaw, one of the most sophisticated quantitative hedge funds on Wall Street. He didn't come from a background in retail. He came from a world of computer scientists and mathematicians who used code to exploit microscopic patterns in global finance. That spring, Bezos found an anomaly in a newsletter that shattered his expectations for the future. For years, internet activity had been flat, until 1994, when worldwide web usage began growing at 2,300% a year. Bezos applied his regret minimization framework to this specific data point. He calculated that if he stayed on Wall Street, he would eventually regret missing a revolution that was mathematically inevitable. He left New York to build a corporate structure specifically designed to intercept and monetize that exponential growth curve. Bezos chose Seattle for its proximity to a major book distributor and a large pool of tech talent. He identified a 1992 Supreme Court ruling allowing mail-order businesses to avoid collecting sales tax in states where they had no physical presence. While his goal was to sell everything, doing so immediately was a logistical impossibility. He needed a single, reliable test variable to prove his model could scale. He chose books. They are pure commodities. A paperback from Corner Shop is identical to one from a warehouse, meaning the customer never needs to physically inspect the product before buying. This solved the primary constraint of physical retail. Even the largest bookstores are limited by their square footage. By operating online, Amazon utilized limitless shelf space, listing millions of titles that no physical building could ever contain. The books were a delivery mechanism, a way to refine a fulfillment system designed for a much larger inventory. To secure this territory, the company adopted a mandate to get big fast. They backed this with $8 million from Kleiner Perkins, the same venture capital firm that funded Netscape. The objective was clear: prioritize the acquisition of market share over the generation of profit. Bezos intended to capture a massive customer base before traditional retailers even understood the shift. This forced a grueling internal culture. Early employees worked 60-hour weeks in a warehouse near a needle exchange clinic, packing books on their hands and knees on the floor until the company bought packing tables. As the company scaled, Bezos showed an unsentimental willingness to replace his original team. Loyal, early engineers were frequently sidelined in favor of corporate executives who could manage a larger, more complex operation. In this environment, both the staff and the technology were treated as components to be upgraded or replaced in service of the growth rate. By 1997, Barnes & Noble launched a massive counterattack. The retail giant sued Amazon over its Earth's largest bookstore claim and built its own website to drive the smaller competitor out of business. But physical retailers are slowed by their own biology. They have massive fixed costs, rent and local staff, and inventory sitting on shelves that require immediate margins to maintain their stock price. Amazon operated on a negative operating cycle. This diagram shows how the flow worked. A customer pays for a book the moment they click order, but Amazon wouldn't actually pay its suppliers for several weeks. Because of this delay, every sale generated a stream of cash that sat in Amazon's accounts. Bezos took that float and immediately used it to pay for more marketing and faster servers. Brick-and-mortar stores were structurally incapable of matching this pace. They had to pay for their physical space before they could sell a single book, while Amazon's model provided the capital for expansion as a byproduct of its sales. The 1997 IPO brought Amazon's methods into conflict with Wall Street. Analysts expected the company to eventually slow down and show a return to shareholders. Instead, Bezos explicitly warned his investors in his first shareholder letter. He told them he would make bold rather than timid decisions, and that the company would continue to lose money if it meant solidifying long-term market leadership. During the dot-com bubble, he raised over $2 billion in cheap debt. He integrated new categories, CDs, DVDs, and software, at a speed that far outpaced his revenue, effectively trading borrowed money for future dominance. Many of those early bets on other dot-com startups failed, costing the company hundreds of millions. But for Bezos, these were acceptable losses, as long as the core mechanism of the Amazon site continued to capture more users. Bezos built a system where the cash from current sales and the influx of long-term debt are combined to fund a perpetual expansion. It is a business logic that prioritizes the acquisition of global infrastructure over the immediate generation of profit.